Good afternoon, everyone, and thank you for joining Mumu's Market Outlook webinar. My name is Jessica Amir. I'm a market strategist with Mumu, and I'm proudly today joined by our esteemed guest. Here they are for you. We have William Ryan, who's the CEO and founder of Granite Shares, bottom left quadrant. David Bird from Mastering the Markets, center at the bottom. And on the far right, we've got Brent Coleman, who's a personal finance content creator that some of you might know. And of course, we have Michael McCarthy. Michael McCarthy is standing by at the minute. So today we are covering a very full agenda, and we are going to be covering nothing that's probably new to you, and we're covering everything that you need to watch and be aware of this year. Where are the biggest opportunities versus the risks? We're covering everything from AI, what is behind AI. Of course, we know there's many subsectors and stocks that are on many of your radars: cryptocurrency, commodities, and defense. And of course, at the backbone of all this, how monetary policy and fiscal spending could shake all of this up. So all of this plus more, plus we'll cover stocks and subsectors to watch. Many of you, I know, are hotly trading some of the stocks that we are going to be speaking about today. But for those who haven't yet caught up on Mumu's Market 2026 Outlook, check that out on our website. Have a look and read. It will be, of course, available on the website right now. But before we get underway, just wanted to also thank you all for those of you who have sent in questions in advance, but we are hoping to get to some of your questions at the end of this webinar. Do keep your questions coming in. We will see them live as the gents are talking. And anything that you want answered, please make note of your questions and write them in the comments section below. But let's just kick off with a monetary policy. Of course, the Federal Reserve just met overnight. We heard from Jerome Powell. Obviously, rates were kept on hold as largely expected. Two Fed members, though, did say that they wanted a rate cut this year. But what was really interesting was that the Fed spoke a lot about how AI is really, causing a whole lot of increase in productivity. So let's go over to Will. Will, you actually have worked on Wall Street. Why do we bring you center stage now? What are you watching when it comes to monetary policy with its impact on markets?
Thanks, Jessica. Thanks for having me. So I think the first thing is that the impact on the dollar is probably the big thing that everybody's watching right now. We know that the Fed has been in an there's a lot of debate going on about how many cuts that we'll see this year, the timing of those and the velocity of those. I think nobody expected a cut at this meeting, and so this was widely expected by markets. Inflation numbers have been fairly steady. They're probably still a little bit higher than where the Fed wants them to be, but still well within, I think, the target range. And so inflation doesn't seem to be causing a problem at the moment. There's a little bit of a softening in the labor market, but again, nothing too much to worry about at the moment. And I think really the focus is continuing to ease this year, but returning to this sort of neutral rate policy, and then keeping an eye on the effect that this has on the dollar.
Thank you. Yeah, absolutely. The dollar has been dropping like a stone, hitting some fresh highs of late. So with the fall of the US dollar, we're seeing the rise of the good old Aussie. So I wanted to bring in Aussie dollar guru, Australian market guru, I guess some would say, David. David, so yesterday, for those that aren't across the Aussie market, what we actually had yesterday was hotter than expected inflation numbers, and basically, suggesting that we could there's a 70% chance that we could get a rate hike next week. But what's your view? What's ahead? What's the biggest focus for you when it comes to the macro side?
Put up a chart saying this is probably the most important chart that us Aussies can watch, which is the AU 10-year, our Australian government 10-year bonds. And the bond traders were not agreeing with what the market was saying, which is that we're going to get cut rates. They had them going higher, and that can be a bit of a forward planning for what's to come. And what I put up was that even though the Fed or the RBA can cut the short-term interest rates, it's the long-term bonds that will dictate what the interest rates are doing. So the fact that those AU 10-year, the kind of crazy thing is it's broken actually a 40-year downtrend. They've been lowering since 1980. And back in 2022, when we had that massive rate hike, we had a big push up. We've had a nice correction. And what I'm seeing on the charts is that it's still going much higher. It will take out the highs from before. So I believe we will get higher interest rates. We are moving into an inflation environment. All the commodities pumping are showing that. So yeah, that's probably the one to keep an eye on. And in regards to the Australian US dollar, it has bottomed out, not seen since 2022 COVID low and GFC, and has just broken through a key resistance on huge volume a couple of months ago. So I believe the Australian dollar has bottomed. If you look back on history as well, the Australian dollar does very well during a commodity cycle as well. From 2003, it went from about 55 cents up into $1.10 in that 2011. And I believe we're going to get something similar again.
Absolutely. Very exciting on the commodity front. Thank you so much, David. So just wanted to go over, while we're staying kind of down under, Brent, you are further south from us, down in NZ. Inflation there still running really high as well. Banks are also flagging a possible rate hike there as well. What's your take?
Yeah, thank you, Jessica, for having me, and thank you, Mumu. So this week we had an announcement around the inflation numbers, and they came in above all expectations. I think the Reserve Bank was expecting 2.7, the bank's about 3, it came in 3.1. So the conversation we'll be having this year is whether inflation is going to be sticky as we go through the following months. So this was quite a surprise for the market. The other thing is that our Reserve Bank here has a sort of target band between 1% and 3%. So 3.1 is definitely above that. And we've also got the dynamic of a new governor this year as well, who's very data-driven. She's from Sweden. She's not from New Zealand, so she hasn't got the kind of government influence. So if she thinks that inflation will be sticky, I think we might even see that rate hike this year. And New Zealand's had a bit of a rough ride, I guess, over the last few years around the growth as well. The markets have been waiting for these lower rates for a long time. Everybody's been, refinancing their mortgages, getting on to those lower rates. But we expected them to be around for a little bit longer. So this was definitely quite a surprise. And we're now starting to see a lot of the swaps markets going up as well. So for lenders and things like that, for borrowers, whether it's, businesses or people, it's come as quite a big shock. We expected it for a lot longer, but it's certainly a surprising one, and we might even see those hikes this year.
Good time for some with rates going higher if you are invested in high yield strategies. But Michael McCarthy, speaking about high yield strategies, Michael McCarthy has been in markets for 40 years. Michael, it's a very exciting time, but I guess it depends on what's catching your eye. Exciting or worrying? What's your take on monetary policy and markets right now?
Well, exciting and worrying. I think that's exactly what it is, Jess, and thank you. The reality at the moment is that we've got very positive momentum. Overall, the outlook remains positive for the year, but there are very significant risks in the market. And inflation is one of those key risks. The potential for an inflationary spiral is very real. Certainly here in Australia, that's what we're seeing. Yesterday's inflation data showed an increase in both core and headline inflation, and it suggests that we might be entering a goods versus wages inflationary spiral. And of course, if wages are chasing the price of goods and services higher, we've got real concerns and the potential for the RBA to stomp on the brakes. Now, that persistence of inflation is not isolated to Australia, and we could see similar effects around the globe. It does appear in the US that inflation is moderating, and the statement we saw from the Fed this morning indicated that they saw inflation risks moderating alongside downside risks to employment. In other words, they're looking at a fairly Goldilocks scenario in the US at the moment, and that should keep markets on course. But of course, any change to that outlook will change not only the outlook for the US market, but for the globe. And I think we're likely to see continuing differentiation. The big mover in monetary policy at the moment is Japan, where we've seen intense pressure on bond markets in particular, and a restructuring of the forward curve in Japan, suggesting a higher interest rate environment. I expect, like a lot of our guests today, that inflation outbreak means that we've seen the lows for bond yields, and we're likely to see higher yields around the world. And that has direct implications, not just for the borrowing costs of companies, but for the valuations. Analysts feed the interest rate outlook into their modelling scenarios, and higher interest rates means lower valuations. Now, valuations have not been a big driver of the market, but if momentum falters at some stage over the course of the year, there is likely to be a return to a valuation-based assessment of the environment, and that might see a resetting. That might mean that price to earnings ratios are compressed, or simply that we see corrective action in equity markets. But I think of overall note is the fact that we're seeing so many asset classes near all-time highs at the same time. Now, this defies the conventional understanding of the economic cycle. The fact that we've got safe haven assets like gold and silver belting higher on a daily basis at the same time as share markets are reaching for all-time highs, at the same time that cryptocurrencies remain elevated, at the same time while bond yields have started to edge higher, are still much closer to historic lows than highs. So all of that suggests that what's really driving the market at the moment is monetary policy. And if inflation means that there's a change to monetary policy, that's likely to echo through all markets at some stage over 2026.
Thanks, Michael. And indeed, those echoes are being reflected in some of the performance of markets as we speak. As Michael just said, and some of the gents alluded to, high interest rates are good for some markets, and perhaps that's evidenced by the fact that we are seeing Japan's market as the best performer in Asian markets as we speak. Japan's market is up 8.3% year to date. While rounding it all out, really interesting to see, in case you missed it, Brazil's stock market is actually up 21% so far this year. So just really outstanding stuff. But let's change pace to something else that was mentioned in Mumu's outlook this year. And of course, we're speaking a lot about investment returns, what your focus might be on this year. And the AI economy needs to be perhaps front and center stage. And maybe that was evidenced by the fact that Jerome Powell spoke a lot about that many times. I don't know how many times he actually said the word AI was boosting productivity, but it was quite a lot. So I just wanted to pause on this now and open it up to the discussion. We do know what we are seeing with earnings estimates. The AI economy build out, that includes data centers being built, the chips to go into the data centers, the storage. Some companies like SanDisk, we've seen that are up incredible, making eye-watering gains this year. SanDisk up 122%, Western Digital up 62%, Seagate up 61% so far this year. We're only 29 days into the new year. Just incredible gains. Micron up 52%. So I guess people are wondering, why they're not invested in memory storage. So that's what we're going to discuss now. I just want to kick off with Will. Will, you see a lot of transactions in the AI space. What is catching your eye? What's exciting you most, and some of the people that you're speaking to in AI?
Yeah, I think the important thing maybe to start with is that AI remains the most important investment theme in the world for 2026. If we can even call it a theme, it's such a seismic change, to society globally, to our markets. That's where we expect the earnings releases for this year, or the earnings improvement for this year, particularly in US markets, to come from. So we're expecting another year of double-digit returns on the S&P 500, driven primarily by the productivity and earnings gains, principally from AI. And I think you alluded to probably the key trend that's happening in AI at the moment, which is the AI trade is broadening out. So it's no longer just all about NVIDIA. The story is moved from just chips and GPUs to other parts of the AI value chain. And this includes the commodity markets as well, as people, both governments around the world and companies rush to grab resources that are key for the AI build out. So I think this is the top theme of the year. It remains the same thing. It remains the most important thing for Wall Street in terms of what analysts are focusing on. I think the key thing is that it's broadening out both in terms of the different parts of the value chain, but also the consumer adoption story. I think 26 is the year when we really start to look more intensely as that CapEx starts to come down a little bit from the hyperscalers. And the story about AI build out is less about CapEx spend, but it's more about real world applications. I think you've seen that a little bit from Elon Musk and Tesla, where the story continues to pivot more towards AI and robotics and away from cars. And you'll start to see more and more companies talk about the real world applications and the productivity gains that come from it.
Productivity gains, indeed. I wanted to thank you, Will. I wanted to now go to Brent for a different take. So, Brent, as we're kind of all saying, we've seen phenomenal gains of late in the AI space, and that has indeed broadened out. It's not just about the chip titans, but it's also about the storage providers. But let's just think about the fact that we did see NVIDIA as one of the most traded stocks here at Moomoo last year. NVIDIA, for good reason, it rose about 50%, and it hit a market cap size of 5 trillion at one point. And then down under, we had the Aussie-born iron. That rose 262% last year. But Brent, what are you watching? I know you've got a very different lens, but that's why I'm quite interested to hear your take from NZ.
Yeah, absolutely. I made a video last year actually looking at some of the top AI stocks. I just wish I followed through on it a bit more heavily, that and commodities, of course. So I think in 2025, there was a huge race into anything AI adjacent. Every business was trying to be more AI enabled. Everything was AI, even if it was loosely just automation and usual tools that already existed. So I think that was sort of our story in 2025, and it is carrying a little bit over into 2026 as well. But I think a lot of investors will be looking for, something a bit more robust. Instead of, something like, can you build it? It's going to be a lot more about, can you monetize it? As Tom Cruise said, show me the money. Companies have the attention, they have the capital, there's a lot of publicity around them. I think investors are going to start looking a bit more for sustainability in terms of their revenue, their earnings, and are they actually having customer uptake? It's not just about other customers signing up for some of these AI-enabled SaaS platforms and things like that. It's about whether they can see those productivity gains. And there's been a lot of media, say like from MIT last year, where they talked about the fact that 95% of projects aren't actually, profitable. So I think there's going to be a lot more focus on that and whether this growth is actually sustainable.
Sustainability is indeed the key. Michael, did you want to say anything that you're watching or perhaps maybe even concerned about in the AI economy?
I think we're in furious agreement here. It's quite clear that the shift in focus for investors is going from growth and the capital expenditure to returns on investment, and that's something we all seem to agree on. The reality is that we saw a year of hype last year around AI. Now those businesses need to deliver on their plans, and that's what we're looking at. I mean, for the details of the transition and for the ETFs and stocks that are directly affected, I'd refer our viewers to the outlook statement itself. There's plenty of detail there, but that's the overarching picture of focus on return on investment.
Thanks, Michael. I just want to expand it out and just bring in the comments from the Federal Reserve Chair. He literally rubber stamped AI this morning, 6 a.m. Sydney time. When you heard his speech, you literally heard him say a quote about AI, and I'm just going to read it out, so pardon me. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI is going to be a huge focus for the US. So this is basically the Federal Reserve Chair saying AI is not hype. AI is real, and that's why he said in a quote that. And he also backed it up by saying this is driving productivity, and it is probably going to drive wage growth. Speaking about growth, let's mix it up and go to cryptocurrencies. Very, very, very wild ride over the past 12 months, but everyone wants to know what's ahead. Should it be a trade? Should it be an investment? Particularly, I wanted all of us to consider the fact that we have not yet seen the US say, hey, we are going to be buying this much Bitcoin. Remember that the Fed, it was added to the US strategic government's asset pool that they can buy Bitcoin just like they buy gold. So I wanted us to consider that. Will that be a catalyst that investors should be considering, or is crypto done for the year? Maybe we can bring in David. David, you spoke at the Down Under. There was a pretty large cryptocurrency conference. I wanted to kick off with you because you were a speaker there. You spoke a lot about what we should be watching, giving away a lot of clues about what could be ahead. Maybe it's not as all it's made out to be. David, give us the lowdown. You're just on mute, mate.
There we go, done. Thanks, Jessica. So yeah, I did speak at Oz CryptoCon around crypto and where we're at. And something that caught a lot of people off guard was the halving cycle. Everyone was programmed into every 4 years, you buy crypto, you get rich. And this is something I wrote about in 2022, that often if you think the market's that easy, it's often because they want you to think that so they can use it against you. So in 2022, I wrote about the fact that this bear market will be different. It'll be 3 times as long. And you'll get that what's called a B wave rally, where you believe that the market is going to do what everyone's expecting, get everyone trapped in, and then you'll continue that bear market. And you have seen that. It's really caught people off guard. Everyone was expecting 2025 to be the biggest year in crypto, especially when Trump came on board at the end of 2024. But the key chart you've really got to look at is others, and in particular, others dominance, which is all of your altcoins against Bitcoin. Okay, so if you're venturing outside of Bitcoin, which is the benchmark, you better make sure you're getting better returns. And the way you can measure that is by looking at that others over it, others dominance. That needs to be in an uptrend. It's been in a downtrend since November 2021. And what caught people off guard was that every other cycle, we were correcting one halving cycle. But how markets work is you take 3 steps forward, 2 steps back. We had 3 halving cycles forward. We're having 2 cycles back now. So there is a chance it can turn around this year. There's no signs of it yet, but it is something I can keep an eye on. But until I see that chart turn around, for me, there's better surf elsewhere. And what I did say is that while everyone's looking left, the big boys are going to go right, which was everyone was looking for alt season. And what have we actually had? We've had metal season. So at the moment, Bitcoin is underperforming against gold, silver, the S&P 500. So it's not beating any other benchmarks. At the moment, no, it's not a place you want to be, but that doesn't mean that that can't change in time.
David, thank you very much. Very interesting. We'll be watching alts and get you on the network back to chat about when we could see a reversal. So I wanted to bring in Will. Will, what are you seeing in the crypto space? What's your take, and what should investors or traders be watching for that matter?
Yeah, it's a tough one at the moment. There's no sort of immediate signs that things are going to change. And, if you think about a market whereby you've got all-time highs in stocks, you've got all-time highs in the metals, different other parts of the market, and crypto is just not reacting, that's not necessarily a good sign. I think what's changed is that, some people will point to the fact that there's still a massive concentration of crypto, particularly Bitcoin, in a small number of hands. And a lot of those hands started dumping around the $100,000 level. But I think more broadly, what we're seeing is that Bitcoin and crypto more broadly is no longer the only game in town when it comes to making money. And if you look at the last decade, there were perhaps a number of periods where returns in equities were pretty lackluster, returns in commodities were pretty lackluster, and therefore a standout return from something like Bitcoin really got people's attention and caused a lot of focus on that particular space. Now we're in a market where not just Bitcoin returns themselves have not been that impressive. We're obviously down over the last 12 months, but we have assets like gold, silver, platinum, all AI stocks, etc., exploding to the upside. And I think that's just sapped a lot of the oxygen out of the crypto and Bitcoin trade. And so a lot of people that we speak to, it's just not the focus that it was some time ago. And people have realized that, hey, it's a competition for attention spans. And now when people open up their phones and they've got a few minutes to decide where they allocate their capital, they're going to the markets that are running, and those markets are not crypto at the moment.
Well, it looks like commodities are probably catching their eye, and that's where we're seeing money flow at the moment. Really good to get your take on that, Will. So speaking about commodities running, I wanted to open that up to the floor. So just before we kick off, uranium prices, uranium obviously front and center with all the hyperscalers like Meta and Microsoft reporting overnight. We've got Amazon ahead and Google ahead as well, but we know all of them are indeed heavily reliant on uranium. So that brings uranium into this discussion. And obviously, as some of the gents have said, gold and silver prices at record all-time highs. So where to from here? We've shared our take, but I wanted to probably go back to you guys first. So David or Brent, who wants to go first? Because David, you've made lots of calls on silver and platinum. Maybe we can kick off with you actually. What are you bullish on now? What should investors be watching? Maybe just chuck yourself off mute when you're ready.
Oh, there you go. Thank you. So yes, we spoke about this last week. I'm very bullish on uranium. I believe it will be the silver of 2026. If you put uranium, the URA ETF, against the S&P 500, the benchmark, it has just broken up from a 5-year consolidation and done a break and retest on the monthly candles. It's had 2 extremely good days from now. Like you probably on the daily time frame, we'll get some pullbacks, etc. But if you're looking at the monthly charts, looking at the big picture, yes, I believe uranium has massive upside. It's entering what's called the public participation phase, which is where you'll start to get media attention. It's pretty much the move that silver did from $30 to now. That's what's called the public participation phase, which is where you start getting the public involved. Prior to that, what's called the accumulation phase, where only the real savvy ones that kind of know what's going on start to really get involved, but it should start the trend quite heavily this year. In particular as well, I'm also very bullish and probably even more so than the American, is the Australian energy sector. It's been in a bear market for 18 years. And the beautiful thing about sectors is that they don't go down forever like an individual stock can. They pretty much react to the macro environment, and the macro environment has changed now. And the last time the Australian energy sector went in a major bull market was at 2003 to 2008, the last time we had commodities going ballistic. So precious metals will lead the run. That money will then start to flow into your industrial metals and your energy. And I am, very excited for the Australian energy space as well.
Thank you. It's really interesting to see also, just rounding it out, it's really interesting to see if you have a look at the earnings expectations across the entire market this year, some of the highest earnings multiples are expected in Australian resources. So Australian resources are expected to see 32% earnings growth. That's more than the NASDAQ 100. So I find that really interesting. Brent, can we get your take? So we've seen this morning, just before we came into here, gold at new records, silver at new records, copper's also galloping up higher, speaking about the industrial argument that that David's just laid out. I mean, I think we're all singing from the same hymn sheet, because you need silver, you need copper, all these industrial metals to build out the AI economy. What's your take, Brent?
Yeah, it's certainly been an exciting time in commodities, that's for sure. We've seen massive gains over 2025, and that's been quite a broad stroke. And some of that in things like gold was a lot of policy uncertainty, and then you get into some of the others that are building out the AI economy. And we've seen much of that continue into 2026. It's kind of a daily occurrence at the moment where we hear it's all-time high silver, all-time high gold. I think it's been the story for about the last week. So that's been a really interesting one to watch. What I'm watching for is some of the geopolitical tension, I guess, around the world that's pushing some of that alongside some of the AI build out. So I think that'll be the thing that I'm really looking for, is if there's more geopolitical uncertainty out of the US with their increasing spending, they've got a weakening USD, and some of the central banks and things getting involved as well, where they've been accumulating over the last little while. And I think that's driving a lot of retail FOMO at the moment as well. There's a lot of retail interest in gold and silver, which has been a long time since that's been the case. So yeah, it's an interesting one to watch.
Thank you. Definitely interesting indeed. If you don't mind, let's go, Michael. You've been covering commodities for many years now. What's catching your eye? Anything that you're really loving right here?
Well, first of all, I like the sector overall because I believe industrial demand around the globe has been underestimated, and India is a big part of that. The Indian economy is expanding at a rate of knots. It's taken over from China as one of the fastest growing major economies in the world. And that demand, increased demand for commodities, has taken a lot of analysts by surprise. A lot of the estimates for long-run commodity prices, particularly industrial commodities like copper and iron ore, were well below the actual spot prices that traded last year. And we headed into this year in a similar scenario with fairly modest demand factored into commodity prices. Now, if that demand is better than expected again this year, then the potential for increases in value in that chain are very, very real. And one of the things I like to see in a market is multiple drivers, and it's one of the reasons I'm focused on the energy market. I think demand has been underestimated generally. I think energy demand in particular is being underestimated because it requires different types. And I particularly like the old school, always on energy sources, coal, oil, gas, and uranium, because the demand that's coming through is always on demand. And renewables simply have not developed well enough the battery storage capability to offer that always on capacity for power that is required by this new demand. So there's a couple of key drivers. I think too, energy policy globally has been based on ideology rather than reality. Green hydrogen is a bust. The potential for real storage is also a bust. And this means there's got to be a swing back to those traditional sources while we use the time to develop other alternatives to these alternative energy energy sources that have failed us. So for those reasons, the energy sector within the commodity cycle is of particular interest to me. And as I say, particularly coal, it's so out of fashion, it's so underwanted, and the future looks so constrained that the multiples these stocks are trading on are, despite a recovery over the course of 2025, still extremely low. In valuation terms, coal stocks...
I can't even unmute myself.
Most compelling cases we've got at the moment.
I can't unmute myself. Great. Thanks, Michael. Very, very compelling indeed. And it makes a lot of sense. You spoke about India to begin with, and perhaps that's why we are seeing a push up in BHP, Rio Tinto and Fortescue Metals. Obviously, these three heavyweights digging up and selling a lot of iron ore increasingly to India. And that perhaps there's a lot to be said about looking at these old heavyweights as they reinvent themselves. Increasingly, we're seeing that with FMG going into copper as well. Will, do you have a quick 60-second take on commodities? What are you watching? Old school, new school? What are you watching, and why?
A couple of things. So first of all, precious metals. I think just to add maybe 1 point, gold and silver has been the topic of conversation here, but I'd say platinum's one to watch. A lot of people felt like they missed gold. They went to silver, maybe missed silver, now looking at platinum. The price of platinum still trades around half of an ounce of gold. In the past, the premium that platinum used to command against gold, in other words, an ounce of platinum was more expensive than an ounce of gold, was sort of so cemented that in the English language, we associate the word platinum with above gold. So a platinum credit card is better than a gold credit card, etc. That's where it comes from. Now, platinum hasn't traded at a premium to gold for well over 10 years now. And while the price of platinum is starting to break out here, if it was to retake gold and trade again at a premium, again, you're talking about an uplift of almost double from where we are today. So that's an interesting story. Platinum is 30 times rarer than gold. It's part of the reindustrialization trade that we're seeing. Also a metal that's used in technologies, from medical devices to electronics. So I think that's interesting. Speaking again of what's going on in terms of reindustrialization and why we're reindustrializing, manufacturing is a key part of it, but it's also, as you've heard from Michael and from others on the panel, about bringing on new power sources to support the electrification of the economy, support AI and the demand for power that we have, which right now far outstrips the amount of supply that we have. To bring all that power online, we're not going to need just the energy sources themselves, but we're going to need the raw materials to allow for the electricity, conductivity, etc. within the system. And that's why you've seen copper going and all of these other metals and commodities, which are critical for that. So I think the two parts most interesting to me at the moment are, platinum and the other precious metals, and then the call them the reindustrialization metals and commodities linked to the AI and power trades.
There's so much to watch. I think my problem is, and many on the panel, so much to watch, not enough money. But not enough money to invest. So much opportunity. So we're going to pivot now to defence. So we've heard NATO speak about encouraging countries to spend over 2% of the money that they make as a nation, let's call it GDP, spend 2% of that on defence each year. And then a la Trump 2.0 gets elected, trade wars, and then we have Trump versus Greenland, and the list goes on and on. But perhaps there's a good reason, whether you like it or not, whether you're an ethical investor or not, we have to point out the fact that some of the world's biggest defence companies are trading at their highest levels in history. one of the world's biggest defense ETFs. It goes by the ticker of ITA, India Tango Alpha. That's trading at record all-time highs as well. So RTX also at record all-time highs. The list goes on and on. We also covered this in Moomoo's 2026 Outlook, so you can have a look at some specific stocks there that we pull out and dissect. But Will, do you mind if I go back to you on this? How is this translating to what is catching your eye, dominating some of the conversations that you're having with investors?
I think it comes down to, again, it's a supply-demand situation where we know that governments are increasing defense spending across the board. The US at the moment has another bill in to increase the defense budget as much as 50%. While that may or may not happen at that level, the trend is firmly the same, that everybody around the world seems to be spending more money on defense. And while, Jess, you mentioned that some of these defense stocks are trading at all-time highs, and that's true from a price perspective. But what's interesting is some of these stocks from a multiple perspective, even though prices are high on a relative basis, are still lower than you'll find for a number of the most famous tech companies in the market. So from that perspective, maybe still, despite the run-up that we've seen in defense stocks, maybe still some value there. But I think the other thing that's interesting about defense is that it's, again, crossing over into AI and technology, that it's not just about the raw munitions manufacturing capability, but it's about robotics, AI systems. There's a huge amount of money going into this sort of tech version of Silicon Valley, or the defense version of Silicon Valley, I should say. And all of this is, highly technology-based companies like Anduril, et cetera, providing the next sort of generation of AI systems. So it's a tech story as well, but you've got, at the baseline, governments spending more money on defense, whether that's for preparation for war fighting or for defense of borders, et cetera. That trend is going one way at the moment.
Definitely a one-way trend, but as I always say, earnings drives share price growth, and that goes back to your point, Will, about the earnings multiples. You need to have a look at what you're buying, as always. But having a look at that angle now, Michael, any quick comments from you on defence or geopolitics? What are you watching?
Yeah, I'd certainly echo Will's sentiment there, that it's not just about the equipment manufacturers. So you can look at Boeing or Lockheed, you can look at the logistics groups like Halliburton, but there are other ways to play this. And the industry change tool on the Moomoo platform is a good way to examine ways to move up and down the defence supply chain. We also have locally listed defence stocks here in Australia. Austal, the literal destroyer class shipbuilder, has contracts both here in Australia and in the US, and may pick up other contracts, particularly in Europe. One that certainly a number of investors are looking at. But of course, the one that traders love is Drone Shield. Drone Shield's share price last year rallied to a high of $6.85, fell to below $1, and has now rallied back above $4. Now, a lot of it has to do with concerns about management selling shares in the middle of last year. That's where the big sell down came from. The bounce back clearly relates to their ability to defend against drones, that perhaps at the cutting edge of defence warfare tools at the moment. So Drone Shield, while highly volatile and a trader's favourite, remains one of the key picks in the defence sector, and of course is listed on the ASX.
Always so much to look at. Thank you, Michael. Now let's get to some of your questions and we will answer them. So there's so many questions to go to. Once again, thank you very much to all of you who have submitted questions. These are some of the lucky ones that made the cut. Let's just go to this first question now. Wanted to see who might take this question. It's a very long question. So the question is basically about strategy, buy and hold. having a look at that socioeconomic uncertainty, what's going on with the dollar, high valuations. I believe that some of these things we've touched upon today, but who would like to have an attack at this? Traditional, old school, buy and hold.
I'm happy to do this one, Jessica.
All right, take it away.
Okay, so looking at the valuations, yeah, 100% correct. They are at extremes. So much, in fact, that if you were to use every metric that you could, every FA metric you could use to value the S&P 500, we haven't been, Warren Buffett, the Buffett indicator, the Shiller P ratio, forward PE ratios, etc. All of them combined, we haven't been up at this level since only 3 times before. 1929, 1970s, 1999, and now. So if you look back at those same dates when you had these metrics, you had 27 years of dead money in 1929, you had 15 years of dead money in the 1970s, you had 14 years of dead money in the 2000s, and I guess that's what people are afraid of now, in the fact that if you buy and hold, history and 100 years of data shows you that you've actually will get pretty much 0 returns for it. Also, if you look at the forward PE ratio, looking back over 100 years of data as well, says the same thing, that you'll get pretty much 0 to negative returns for the following decade after that as well. Funnily enough, with those same dates that I just showed you then, 1929, 66, 1999 and now, were also the exact same time that the gold to Dow ratio was at the bottom, okay, which is where gold outperformed equities. And that's what happened actually last year on the 3 monthly candles. We actually had what's called a change of market structure, which is a reversal, which is why you've seen a dramatic outperformance of commodities against equities. A lot of people are calling the top on commodities already. I believe it's actually the beginning of a major macro trend that has only happened 3 times before. And often, when everyone's calling the top of something, it's not the top of something, it's actually the beginning of something. Everyone was positioned for the last decade trade, when the next decade will be those commodities, in my opinion.
I think your opinion is definitely echoed. We're seeing that with ETFs buying, ETF investment managers buying gold as well. So plenty of ways to skin the cat. Let's just change pace to the next question. Not sure who wants to take this one. Another long question, but thank you very much to Novice Invest for submitting this question. Couple questions here, we can pull this apart. How likely will the US Federal Reserve raise interest rates, even though they've just kept them on hold? And 2 members did keep ushering the need to cut interest rates, but nevertheless, we have got this question here. Who wants to take this question just about the US dollar, geopolitical risk, and market sentiment, liquidity, asset pricing? So many questions there. Who wants to take this one? How can you optimize returns is basically what I think they're trying to ask.
I'm happy to have a go.
Taking in caution and risk. All right, Will, take it away.
Yeah, I think the answer to the first question is extremely unlikely for the Fed to be raising rates. The Treasury Secretary today certainly talked about this in the context of intervening in the currency market to strengthen the dollar. Said, I think his exact quote was, absolutely not. So I think in many ways the administration, wants the dollar to weaken, and that's kind of been the game plan since they took office. And that does a number of things that helps their agenda, but most importantly, bringing interest rates down, which helps refinancing some of the US debt. We all know that Jerome Powell's term as Fed chair is coming up in the next few months. The president, the administration have been interviewing replacement candidates, of which I'm sure they have, if not the final candidate already identified, they know which one out of maybe 2. And of course, that candidate will be highly incentivized to lower interest rates vis-a-vis the administration's sort of task. So I think, the dollar goes weaker from here, and that's partly what we've seen reflected in gold and some of the other hard assets out there. So that clearly is a risk, because at the same time, while we often talk about the benefits, just the benefits maybe of interest rates easing and financial conditions easing, there of course are risks. Inflation hasn't disappeared. I don't think anybody can plant the flag and claim victory over inflation just yet, especially while there's still uncertainty around the tariffs, and while that risk is eased somewhat. The odd tweet here and there that threatens a new country with escalating tariffs, etc., always puts that at risk of flaring up again. So I think that inflation is still a risk out there, along with the geopolitics that we see. We're in a world which is reindustrializing. It's becoming more polarized. We're moving away from globalization, and there are risks inherent with all of that. I think in terms of the sectors that offer the strongest opportunities, we've probably by default ended up talking about the main ones on this panel because they are the most topical. And then commodities more broadly. If you're looking for value, in air quotes, in this world today, I think broad commodities is probably the place to look. But outside of commodities, we've mentioned AI, we've mentioned robotics, quantum computing, defense. These are all areas that I think are going to continue to be in focus this year. So certainly, I think we've covered probably the big ones on this panel today.
Thank you, Will. I do want to get to perhaps one or two more questions, if we may. There are so many questions, but thank you again to everyone who submitted a question. This one is about the midterm elections, question 3. So midterm elections, historically more volatile, with markets often turning more constructive once political uncertainty fades. I guess that statement's pretty correct. Given the current rhetoric around Greenland by hook or by crook, and Europe's consideration of trade-related countermeasures, what could be an effective investment playbook for 2027 from a commodity member, Lazy Cat Invest? I actually really like that question. I think Will touched upon some of the key sectors to watch, but without giving it all away, does anyone else want to add their 2 cents on the key sectors to watch after uncertainty fades?
I can talk around the cycles, definitely. So they are correct. You've got to remember, with markets, they're very complex. You have cycles within cycles within cycles. And this is what really caught the crypto crew off mark with the 4-year cycle. Crypto had only been around for 12, 13 years, and they believe that that's how it runs. But there's cycles within cycles. So within the market, you've got your short-term cycles, which are weeks to months. You've got your medium cycles, which is 3 to 5 years, which is the election cycle. And yes, 100%. Typically, the midterm election year is a year where you typically get a lot of volatility and probably even negative returns. So if you look back 2022, 4 years ago, negative. Before that, 2018, negative. Before that, the 2014, which then led into the 2015 bear market. And then they kind of go back. If you look back on a chart every 4 years, you'll see there's some form of correction. You also get the business and equity cycles, which are roughly 7 to 10 years. So that one also lines up with 2026 as well. And if you look back every 7 years, you'll notice the same thing as well. Then you get generational cycles, which is probably what you've heard as the real estate cycle, the liquidity cycle, and that also comes in 2026. So we've got to be careful of that. And then in particular as well, we have the very long monetary cycles, which can be 40 to 60 years, which we've had in the yields. So we've had a low interest rate environment. We've had from 1980 since they peaked. If you look back on that US 10-year, you'll notice they bottomed in 1940, they topped in 1980, they bottomed again in 2020, on those 40-year cycles. So that's why I believe we will go into an increase in interest rate environment in the long term. Yes, there may be some short-term corrections from Trump having to cut, but I believe they'll be short-lived and it will eventually go up again. So yeah, that's why 2026 is definitely a year to be careful, because you've got multiple cycles all colliding in 2026.
Multiple cycles and Trump 2.0. We know volatility is a key theme, and so is geopolitical risk. That brings me to the bottom question that we can see on the screen now. This question I do want to jump to because I'm just conscious of time. The question is, I guess, the final part of the question number 6, which is at the bottom of the screen, is specifically asking for the outlook for gold and silver. Do current valuations suggest they're overvalued? I really wanted to get your take on this, gents. It's going to have to be a rapid fire. The first part of the question is as well, are AI chip-related stocks like NVIDIA overvalued, and should investors start to look to other parts of the AI value chain? We've discussed that today, such as memory, storage, data centers. Yes, indeed, broadening out is warranted. So very, very quick, rapid fire from all of you, if I may. Gold, silver, and AI-related space. What's your take? Who wants to go first? Rapid fire.
Yeah, I'd suggest in AI, it might be worth looking at, instead of mining for gold, selling the shovels. And so I'd be looking at the very bottom of the chain there, those resource stocks, the rare earths, the power commodity exposures that will feed it from the very ground up.
Picks and shovels, like it. Thanks, Mike. David, let's just go in order. What's your take?
Not overvalued, could get a healthy pullback. If you adjust gold for inflation, it actually only just broke out of a 45 new high last year. So it's been, and silver actually still hasn't taken out the 2010 high, adjusted for inflation as well. So no, nowhere near undervalued, but as we know, markets zig and zag, and there will be a healthy correction sometime this year.
That's why I love doing stuff like this, because you get a different perspective, and that's exactly what makes the market. So speaking about what makes the market, William Rind makes ETFs. William, let's go to you. What's your take?
On AI, definitely not overvalued. I think to take a sports analogy, you got to ask yourself, are we at the beginning of the game or are we at the end of the game? And I firmly believe when it comes to AI, we're at the beginning. So if we're at the beginning, it's not overvalued. Comes to gold and silver, similar thing. I've been involved in gold a long time. Maybe don't want to date myself too much, but go back to the days when people could not foresee the price of gold breaking $1,000 an ounce. These are people that have been in the London bullion market for a long, long time. And, you know, you have to go back 10 years to the gold bugs on YouTube and things predicting $5,000 gold. And they were right, just took longer perhaps than people thought. So every time I've seen a gold top before, the market has consolidated and has always followed another high. And I think we're in a situation where gold has just become the de facto alternative to the US dollar. It overtook the euro earlier last year. And so this is now in a world that is deglobalizing and where the dollar is perhaps becoming less important to other countries. They're de facto going to gold.
Go to gold. All right. Let's go to Brent now. What's your take? Gold, silver, AI stocks?
Yeah, so I guess on the commodity side, as everybody else mentioned, I think we are definitely not at the top. I think there is a lot more opportunity in that space. And as we build out some of those infrastructures and things around AI, it's only going to be a lot more important. And if the Defense of War, the sort of group assembled by Trump, the Department of War, is going to pursue that, they'll need the resource. So I think that's a very bullish area. On AI, I was at a conference a couple of weeks ago in Dubai on content creation. We're just at the start of where AI is going to really revolutionize the creator economy. Video is probably the area of AI I think has grown the quickest. we've gone from, if you've seen the Will Smith video of him eating spaghetti, we've gone from absolutely trivial to really lifelike. And there's a lot of technology out there that's growing and building. And there's a lot of people profiting off it as well. So I think there is a lot of growth to come in AI, especially in my space in the content creation area. I think it's going to get really exciting really quickly.
Speaking of very exciting, very quickly, bring everyone into the discussion now for our final hurrah. 2 minutes to go. 2 minutes to go means we want to give you, the listeners and viewers, a final takeaway, what you should be watching for 2026. Extreme rapid fire now. Let's go. 30 seconds or less. Michael McCarthy, main focus, key focus.
Stay invested, protect the downside.
David, you're on mute.
With metals have led the charge. What we will rotate into now is your industrial metals and energy. So don't chase yesterday's winners. They've had the first run. Look for tomorrow's winners. Skate to where the puck is going, industrial and energy.
Will.
I think just to state what we've already said before, which is a continuation of AI and commodities will be the two big themes for this year.
Nice. And Brent, what do you have?
Yeah, what I'd written down was what everybody else had, sticking the course, making sure you protect the downside and don't pick last year's winners. It's a new year. There's new things that will be emerging, and keep your eye on what's happening out there.
Always so much to watch and listen, but thank you very much to our esteemed guest, and thank you at home or at work, wherever you're tuning in from. I'd also like to call out and thank William Rind, CEO and founder of Granite Shares, David Bird from Mastering the Markets, Brent Coleman, personal finance content creator, and of course our CEO, Michael McCarthy, CEO of Australia and New Zealand. And I'm Jessica Amir, market strategist from Moomoo. For more information on all the stocks and ETFs we've mentioned, we encourage you all to use the Moomoo platform. Stay safe and stay invested and ride the wave.